Welcome to SilverOak's quarterly webinar. My name is Shannon King, and I am President, Partner, and Chief Compliance Officer of SilverOak. With me today is Jonathan Charlo, also a partner and our lead analyst. And Jonathan, I assume you're on the other line with me?
I am. Welcome, everyone.
Well, as you can tell, we are still practicing our COVID procedures. So Jonathan and I are in separate locations conducting today's webinar. Hopefully, our next webinar, Jonathan will be back together. I think they maybe run a little bit more smoothly when we can actually see each other, but I think we'll make do just for one more quarter like we are here. This webinar is scheduled for approximately 45 to 60 minutes. A copy of it will be posted to the SilverOak website after the webinar has concluded. If you have any questions throughout the webinar, please feel free to contact your SilverOak advisor after the session ends. If you're not working with an advisor here at SilverOak, you can contact me directly at 952-896-5701. And of course, I want to thank Jonathan and John and all of the other members of our SilverOak team who make today's webinar and all of our past webinars possible and successful. So a lot of work goes into this, probably significantly more than anybody can imagine. So I appreciate all those efforts. And of course, for compliance purposes, I must note we will be discussing the overall markets and economy during this webinar. In doing so, we'll be providing our interpretations and perspectives. You should not rely upon this information as fact when making any investment decisions. Also, we will not be discussing specific SilverOak portfolio performance as each of our clients' portfolios are customized. Nonetheless, all of our clients should have received their customized performance reports certainly within the last couple of weeks. If you have any specific questions, feel free to contact your advisor if he or she has not already contacted you. And of course, the last disclaimer that everybody's heard a million times, past performance is no guarantee of future success. So let's look at today's agenda. As usual, we'll start with a brief summary of economic data for the last quarter.
Sorry, I couldn't quite hear you. Could you please?
We'll go through the market data for the quarter.
I found this on the web.
My apologies. My iPhone, Siri, is thinking I'm talking to her. Let me turn that off. My apologies. So again, we'll go through the economic data, then we'll transition into the market data for the quarter. We'll transition from that point into SilverOak's outlook and what we expect the next quarter or maybe even next year or so to look like. Since there's been so much buzz around inflation here recently, we are going to spend a few minutes toward the end of today's webinar to discuss our perspectives on inflation and hopefully give some insight there. We have a few brief updates with regards to SilverOak activities. And then, of course, we always conclude with questions, which, by the way, we did get a question just maybe a week or so ago with regards to cryptocurrencies. And I think it was specifically in regards to Bitcoin, but more generally, I guess, cryptocurrencies. We are putting together some information and conducting our ongoing research of cryptocurrencies and hope to have that as a separate topic for future webinars over the next couple of quarters. So look to see more information coming out on cryptocurrencies. So Jonathan, as we start the data points for today's webinar, you point out here that the economy was strong in the first quarter. And I suspect we can see that with the market dashboard numbers.
Yes, absolutely. In fact, we saw pretty good improvements across the board. So kind of starting with the economy, you'll see that we transitioned from neutral in the fourth quarter to positive in the first quarter. Credit markets also transitioned from neutral to positive. Valuations really didn't have a change because as we've talked in the last couple of webinars, the valuation for the markets are relatively high currently. And then market sentiment has seen an improvement starting last fall, and that continued again into the first quarter, leading to a movement from negative in the fourth quarter to neutral in the first quarter. And then what you'll also see is we have the projected numbers for each of these components. And right now, our projections for next quarter are no changes from where we're at currently.
And part of that's probably due to, as we look back, and again, we post all of these webinars to our website, so you can look at our forecast going back in time. We had anticipated that these couple of categories that got upgraded would actually not be upgraded until Q2 of 2021. So we're actually a little bit ahead of what our forecast was, which is good news. The other good news that we're going to see is we look at the market dashboard on a trailing basis and start to think about what it's going to look like moving forward. Obviously, there was a big dip as a result of COVID with major pullbacks across the board last year, but strong recovery. And now we are ahead or above anyway, important thresholds for both the current and the 6-month trailing. And basically what that's indicating is that we are expected to have more favorable conditions for the markets. If we're above those thresholds, either 3.15 on the current or 3.25 on the 6-month rolling, those are kind of the thresholds that if you're above that, it tends to favor market conditions. As we look at the scorecard, you're going to see here that we've actually become to be a little bit more positive in sentiment on a couple of these categories. So fiscal policy and global growth, our sentiment has improved. Now there's one where the sentiment is reducing a bit, interest rates. And that's because we did see, and we'll talk about it a little bit later, interest rates rise during the first quarter. And we'll talk about the impact that had on fixed income prices in a few minutes. But we did shift a little bit downward on sentiment for interest rates. Now on the flip side, several categories were improved or actually shifted from negative and neutral or from neutral to positive. And those that shifted to the positive, credit conditions, corporate earnings, employment, and consumer confidence. You can see that with all of them having the plus sign. While US inflation that ties into interest rates has the negative sign, that was the one that was actually downgraded from one category to another. But Jonathan, overall, scorecard looks very encouraging.
Absolutely. Now let's talk about GDP recovery. So on this slide, we are showing the steep decline that we saw last spring as a result of COVID. Then we saw a very, very nice bounce later in the summer. And then you'll see that the next quarter, we saw a little bit of an improvement. Now, the last item we're showing is really that gap. So we're not back to where we were pre-COVID, nor are we back to the trend line. But Q1, the blue chip consensus is estimating kind of a 5% GDP growth quarter, which is strong for a first quarter, but for the year, we're looking at 5 to 6% GDP growth. So by the end of the year, we should be close to where we were pre-pandemic.
And we've also seen with the pandemic, obviously, a big shift in the service versus the manufacturing sectors. And so what this slide is showing us is literally the manufacturing PMI minus the service PMI. It's pretty obvious that with the shutdown of the service sectors of the economy, that manufacturing really started to take over. And you're going to see that big uptick in the line showing that really it's manufacturing that was driving everything. As we've had a restart in the economy and the service sector is at least beginning to reopen, we're starting to see that come back down to more typical levels of the manufacturing versus service sector. But still, even now you can see at the far right, manufacturing is making up a bigger percentage of global activity than is services. But we would anticipate that as, again, the reopening continues to occur, or hopefully will continue to occur, that we'll come back to more typical levels between manufacturing and services. Now, we also saw, obviously, a big uptick in unemployment with COVID, and a corresponding improvement as the economy has reopened and people are getting back to work. As a matter of fact, we are pretty much right at these historical levels of unemployment. The historical average, at least over the last 50 years, is 6.3%. In February, the unemployment numbers came in around 6.2. So statistically, pretty much right on to the historical average. Where we're still seeing a little bit of a difference is in wage growth. Wage growth is just a smidge higher than its 50-year historical average. Nothing of great significance to be concerned about, but it's worth nonetheless pointing out. So I've already mentioned, Jonathan, a couple of times here, the impact that the reopening has had, whether it be on unemployment, manufacturing, but we also obviously are seeing it with consumer activity as well.
Absolutely. So we've shown this in the past, and so this is really an update. So what we really want to see is what has happened really since February on. And so if we look at the green line, we look at the purple and the light blue, those are all consumer activities. So TSA traveler traffic, US seated dinners, these would be reservations on OpenTable, and then travel and navigation app usage. You can see that those lines are trending up. And so clearly that started again in February, which really corresponds with more people being vaccinated.
And hopefully, with all the activity that we've talked about and the rebound of the economy thus far, that's going to transition into stronger corporate earnings.
Yeah, absolutely. So 2020, obviously, corporate earnings were affected by COVID. The expectation is that we'll see a very strong rebound in 2021, and you're going to see essentially the blue would be the kind of recovery numbers for 2021. You'll see that the most impacted industries like energy, industrials, consumer discretionary and financials have very, very healthy bounces, including energy, which you see a squiggle. That's just showing that the recovery and the losses were much greater than 60%.
And we have talked about this a couple of times, have we not, Jonathan, over the last really 2, maybe even 3 quarters, that we were anticipating earnings to recover as the economy reopened, and sure enough, that's exactly what we're seeing.
Yeah, yeah, and a lot of it will be coming in the next 3 quarters. Obviously, Q1 has been good so far, but we are expecting a ramp from here.
So overall, when we think about the economy, probably no surprise, as people are getting vaccinated, the economy is getting reopened, we're seeing the economic activity pick up, and that's corresponding to good earnings. So, of course, earnings help drive market valuation. So let's talk about what happened in the quarter for the markets, and specifically, we'll start here with equities. The good news is the quarter was very, very strong in equities, kind of a continuation of a strong 2020. As a matter of fact, if we look on a one-year rolling basis, you're seeing some just eye-popping numbers here. Remember, this is really coming off of kind of the bottom of the market as COVID hit in March and maybe April of 2020. So good, strong performance pretty much across the board. As we look here, we get the fixed income performance. Here's where you're going to see a little bit of downside. I mentioned when we looked back at the dashboard and talked about the scorecard, the interest rates had creeped up. We started the year with a 10-year Treasury probably around 1%. It got as high as 1.75 or so. I think it's trended down back into the 1.6 or so range now. But as those interest rates went up, especially in such a condensed period of time, we did see some pricing pressure in the fixed income markets. But still eking out slightly positive for the one-year trailing. So talk to us a little bit, Jonathan, about the makeup of the equity markets and the large versus small and the value versus growth composition.
Yeah, absolutely. So again, as you mentioned, first quarter performance was good generally across the board. So what we can see is value actually did lead the way. So up almost 11% in large cap, mid cap up a little more, up 13%, and then small cap leading the way, up 21% in value. But if we look at small kind of across all of the styles, you'll see that in the blend category and the growth category, that small led the way. The only negative number we're really seeing would be in the mid cap area, where it was just down slightly. If we look at the one-year numbers, really the other thing to be gleaned is that coming off of the bottom, small caps have led the way across all of the style categories.
Well, and that's interesting. Let's look at small cap versus large cap. And by the way, if folks on the webinar aren't exactly sure what we're referencing when we say small cap, large cap, we're just essentially referencing the size of the company. So cap is capitalization. The larger capitalization companies are the bigger companies versus the smaller cap that are the small companies. And what we've seen here is large cap, going back to Q4 of 2019, has had pretty strong quarterly performance, with the exception of course, that first quarter of 2020 when COVID really hit. Small caps have had kind of mixed performance on a relative basis. They got hit a little harder in the first quarter of 2020 as the economy was really going into a recession because of COVID. But they also have led out of the bottom of the market, as Jonathan has just indicated on the prior slide. Now, what's interesting is if you go back 7 years, just 7 calendar years, large caps outperformed 5 of the last 7 years. Of the 2 where small cap outperformed, one of those years, it just barely outperformed. In 2020, actually, as a year, small cap did outperform, but just barely. 2016 really has been the most recent year that small cap outperformed by any meaningful amount. So it's been a while since small cap has really had any favorable winds. Now, Jonathan also mentioned value outperforming here more recently. If we go back quarterly, what you're going to see here is the growth performance on a quarterly basis going back to that Q4 of 2019. Pretty obvious when COVID hit, with the first quarter of 2020 being the negative outlier here. If we compare value to growth, just like with small cap that underperformed in the first quarter of 2020, value also underperformed in the first quarter of 2020. Now, it really didn't have as strong of a comeback until really most recently, over the last 3 or 4 or 5, 6 months. Now, if we go back over the last same 7 years that I just referenced with small caps, it's quite intriguing that growth has outperformed 5 of the past 7 years, just like large cap outperformed 5 of the last 7 years. And it also just so happens that one of the 2 years where value outperformed, it just barely outperformed. That was 2019. And it just so happens that 2016 was really the last time value outperformed by a meaningful amount. So 2016 was favorable for both small cap and for value. And it's really been the most recent year that we've had that outperformance by small and by value. So Jonathan, as we think about this recovery from our most recent major market pullback and real recession, COVID induced, talk to us a little bit about kind of the bifurcation that we've seen in the market.
Yeah, absolutely. So the growth versus value performance has a lot to do with the industry groups and how they have done. And so if we look on the bottom part of the slide, you'll see pandemic beneficiaries. And so you'll see that technology in the first half of this period far outperformed how it did in the second half. And we can see that in consumer discretionary as well. So during the first half, we saw very, very high returns from technology and consumer discretionary, whereas they had modest returns in the second half. If we look to the right side, though, the companies that we would kind of label as the reopening trade, meaning the economy is reopening and we'll see improving growth, the type of industries that would do better would be on the value side, so energy and financials. Now, they still were up nicely in the first half of the year, but certainly energy saw much stronger performance in the second half. And if you compare energy's performance in the second half versus technology and discretionary's performance in the second half, you can really see why value did better in the fourth quarter of last year and in the first quarter of this year.
So we've talked a lot about value and growth and even large cap and small cap, mostly oriented toward the US markets. What have we seen in the international markets as far as returns?
Yeah, so in the first quarter, it was really more mixed than in the US. We did see some categories that were up, but we saw some that were down. And in fact, Latin America was down about 5%. And I think really what the market was reacting to were the variants and the fact that outside the US, other than say Israel or the UK, vaccination rates were lagging a little bit. But if we look at the prior 1-year returns, nice strong returns across the board, but again, a little bit less than what we've seen in the US.
Well, and that leads us right into the next slide here, where if we look at the US markets, again, going back quarterly to the fourth quarter of 2019, real strong US markets with the exception, of course, of the COVID quarter. But if we compare that to the international markets, with the exception of the fourth quarter of 2020, the US has pretty much outperformed each one of these time frames. And again, going back, I talked about the last 7 years when it relates to small cap or large cap then growth versus value. Well, over the last 7 years, the U.S. has outperformed 6 of those 7 years. And the 1 year that the U.S. did not outperform, which was in 2017, it was only off by a couple percent. I think 3%. Actually, it was a pretty big year in the market. So really, over the last, almost decade, international stocks have just not kept pace with the U.S. markets. And I think we're going to touch on that a little bit later in today's webinar as well. How about, though, before we get to that, Jonathan, why don't you touch briefly on the bond markets? I mentioned that for the quarter, bonds were down a little bit, but that's the overall bond market. Were there certain parts that got hit harder than others?
Yeah. So essentially, Treasury bonds were really hit the most, and of course, the reason is U.S. Treasury bonds have no credit risk, so it is really all interest rate risk. And so with yields rising, essentially the bond values fell more. If we look kind of to the left side, you'll see emerging markets and corporate bonds were kind of hit as well. And we really only had a couple categories that were up a little bit. But generally speaking, it was the interest rate effect that affected the bond market. Now for 1-year returns, generally speaking, returns were better. And so we mentioned the Barclays US aggregate did have a nice year. Now, again, if we look to the far right side, you'll see that the Treasury category, and this would be the 10-year Treasury, is actually down for the 1-year period as a result of much of the performance in the first quarter.
So as we look forward, I mean, this is great data. It's giving us, a perspective on where we've been. But as we look forward, let's talk about what we expect to see. And let's start big picture, again, with the U.S. economy first. Obviously, the recovery is highly dependent upon the COVID reopening. We anticipate to get to a herd immunity, and we hope that all of the vaccinations are going to continue to progress. It looks like things are picking up, at least in the U.S., very, very encouraging signs there. Of course, we are at risk of new variants that may not be impacted by the vaccine, but that is hopefully a tail risk. And the base case is that the economy continues to restart. Of course, fiscal and monetary policy continues to be super supportive as well. We have potential for another infrastructure bill. I think Republicans came out, I can't remember the exact number, but I think they were around 600 to 800 billion. I think Democrats are talking about 2 trillion. Maybe they end up somewhere in the middle. Frankly, all those numbers I just mentioned, those are real dollars. I mean, those are some serious dollars that could go into the system on top of everything else that's already been pumped into the system. And we actually believe interest rates are going to remain low relative to historical levels. And that's because we actually believe what the Federal Reserve is saying. And the Federal Reserve has indicated they are in no hurry to hike short-term rates anytime soon.
So along those lines, Shannon, on this slide, we're really looking at what are the two kind of things that the Fed is looking at. And so they are kind of, again, looking at this idea of 2% long-term inflation. And when we look at that, well, we know in the short run, and we'll see that later when we go through inflation, that it's a little bit higher. We're still well below kind of what the Fed is targeting long-term. And then on the right, we can see kind of the unemployment numbers. And so the top of the blue bars are kind of where we are currently, and the kind of orange diamonds are kind of where we were pre-pandemic. and then the green circles are where we were kind of last March. So we've improved quite a bit, and we saw that in the unemployment numbers, but there's still quite a bit to go. And so the Fed really is looking at these two measures when they said that they're going to remain accommodative at least through next year. So looking at the international economy, it's much like the US. Now, the one thing we do know is that the US is doing a relatively good job. Now, we know the UK and Israel might be a little bit ahead of us, but generally continental Europe has lagged the US from a vaccination standpoint. So here we've said that they've lagged by about 4 months. But again, globally, monetary policy remains highly accommodative. Now, the one thing we do note is that China's growth has been stronger, throughout, and we might not see it bounce as much as the U.S. and Europe going forward, because currently they're trying to restrain credit growth. They're also looking at inflation potential as well. But generally speaking, as we enter the second half of the year and go into 2022, we should see the global business cycle pick up and start to recover.
Now, you mentioned Israel just briefly. So why don't we talk about what's happening there? And is that any indication of what maybe we could see or other parts of the world, Europe particularly, could see?
Yeah, absolutely. So on the left, you're going to see kind of the percentage of the population who've been vaccinated against COVID. And you'll see in Israel, that is a relatively small country, they've exceeded 50%. Now, early on in January, February, they were in lockdown, but as a result of hitting kind of that 50% vaccination level, they did ease their lockdowns. And so you'll see that restaurant and tourism activity increased substantially. If you look to the right, you'll see kind of in the blue kind of their economic activity, and that dotted black line is when the lockdowns were eased, and you'll see that it ramped substantially. So then if we look at that green line, that's Europe. And so I mentioned that Europe is probably 4 months behind the US and obviously behind Israel. So as they start to get more vaccinated, we should see economic activity pick up in Europe.
So of course, the economy isn't always measuring or indicative of what's happening in the equity markets. As a matter of fact, the equity markets tend to be forward-looking. Economic data is always backward-looking, so we can at times get mismatches. We didn't put it in today's webinar, but I thought I would remind everyone, we did show maybe a year or two ago a slide that bifurcated GDP and looked at the stock market returns based on whether the calendar year GDP was a strong year or a weak year. And what we see is that there's actually a pretty high correlation between when we have really high GDP, the stock markets actually don't do as well. And when we have low GDP, stock markets tend to do better. However, that's not always the case. And of course, the timing is difficult to identify. So as we look forward, we were just talking about the economy and our outlook. As we look forward in the markets, we do believe fiscal and monetary policy will likely help support returns. Now, we understand there are some high asset valuations that are reflecting really positive expectations. So they're susceptible to potential pauses in our reopening, and maybe even susceptible, and we saw this yesterday, Jonathan, susceptible to possible changes in U.S. tax structure when it was indicated that maybe capital gain rates would be going up, at least for the high income earners, to ordinary income rates. I think people knew that could be a possibility, but the closer we get to it actually occurring, I think the markets may reconsider the current level of valuations. And of course, we expect volatility to increase because of the potential for rising interest rates and potentially inflation as well, which we'll talk about in a few minutes. Now, there are a couple there's a lot of different parts of the markets. So when we say there are high asset valuations, that's just generally. In a few minutes, Jonathan's going to go through a slide that will show that actually there's parts of the market that are still maybe not highly valued and maybe even considered undervalued. But growth, when we talk about growth versus value, growth does seem to be a little bit stretched. Okay, and overall, our cyclical outlook still remains quite constructive. So Jonathan, why don't you walk us through this? And what are we trying to garner here from our COVID experience with the experience that we had at the end of World War II?
It's certainly the human condition where you are always trying to look to see if there are analogs to the past. And so this is a slide kind of looking at what the challenges were following World War II and kind of what the policies were. So you'll see that there was a sharp recession following World War II. We obviously had a sharp and short recession following COVID-19. We also were in a period where public debt has surged in both cases. We had the GI Bill and other bills passed after the war. Now we have the Build Back Better plan. And then when we look at kind of the Fed during those periods, it was also very, very accommodative back then as it is today. And then when we look at the financial system, we're kind of looking at the fact that banks were kind of recapitalized back then. They have as well here. But also household savings rates were very, very high at the time. And then we had talked in the last webinar how savings rates peaked at little less than 20% in the fall. So the interesting thing was after World War II, we saw a shift to domestic spending. Here, and again, we've talked about this, is that we're likely to see a shift back to services spending away from kind of big ticket items that help manufacturing. And then if we look back to how did the market perform in that 1946 to 1950 period, we're kind of showing those returns. But the interesting thing is back then, US value stocks actually did outperform. And so we've talked about the services spending shifting back to potentially companies that were badly affected that will get better. And so historically, we've seen this shift occur in the past as well.
Sure. So let's look at the next slide here and talk about how interest rates could impact valuations. I mean, obviously, throughout today's discussion, we've talked about interest rates. It's kind of a common theme throughout all of the different sections of today's webinar. Walk us just really briefly through this slide.
So this is just on a general basis looking at the S&P 500 PE or valuations over time relative to the level of bond yields, in this case being the 10-year Treasury. So if you start from the far right at a 0% interest rate, you can see that you would have a very, very high valuation. So a little, between 35 and 40. And then as rates start to tick up, you see that kind of go down. And so the first red arrow is really showing us where we were at the beginning of the quarter, kind of at that 1%. And so, historically at that level, the markets could support, a multiple between 25 and 30 times. And then you've mentioned that, by the end of the quarter, we were kind of sitting in that 1.7, currently at 1.6. So you can see that that multiple kind of comes down a little bit. And then the third arrow is really showing at 2%. And the reason I chose 2% is that's probably where we could see the 10-year Treasury go, later in the year. And so we could see valuation come down modestly from where we are, but still above a 20 multiple. And so unless we see bond yields really go higher, we're probably not going to see a huge impact to valuation.
Well, and I think we can see that on this next slide too. And this is a super complicated slide, but basically every square is a different monthly number representing a rolling 2-year correlation between the 10-year Treasury, which is on the x-axis, and the rolling 2-year correlation on the y-axis. All you really need to know is that interest rates need to really get to that 3, maybe even 4% range before we start seeing equity returns negatively impacted. And some would argue even above that 4%. So this is just a scatter plot that kind of concludes that 3 to 4% range is probably anything above that, maybe not as constructive for equities. But in the meantime, we're a long ways from 3 to 4% on the 10-year Treasury. So let's talk about how earnings could help valuations, because we just talked about how interest rates could impact valuations. But let's touch on earnings.
Right, so valuation, or PE, is price to earnings. And so let's again talk about the earnings. So we know that COVID really impacted earnings last year, and we're expecting a very healthy recovery this year. And so if we look at the diamonds on the far right, EM in this case stands for emerging market. The forward 12-month earnings are expected to rebound a little less than 30%. DM stands for developed markets. They're supposed to rebound this year by almost 24%. And then the US is expected to rebound almost 21%. If we see these type of earnings rebounds, that means even if the prices of the market stay where they're at, that the valuation will come in slightly just because of the higher earnings.
Sure. Well, and again, going back to a discussion we had earlier on value versus growth, US versus international, this next slide here is the slide that I was referencing, where I mentioned overall the market seems to be pretty highly valued, but there's pockets where that's not the case. And we're seeing that actually there are certain parts, maybe the more value-oriented parts of the market, that aren't as highly valued. And there's indication that maybe value will outperform growth. Although some of that, admittedly, Jonathan, we've seen rotate back in favor of growth most recently over the last couple of weeks. But you have reason to believe that we could be on the cusp of a shift, and I think this is one of those reasons to think value might come back. And that is the rising prices, is that right, Jonathan?
Yes, yeah. So on the left, we're looking at raw industrial prices. They have really, surged in this recovery. We've seen the corresponding increase in value equities. And the thing I'd mentioned is you typically see a strong rebound in industrial prices early in a cycle, and that's really what we see on the right. But there could be more room for value stocks to rebound relative to growth stocks.
And this is giving us kind of the same conclusion, but looking at economic recoveries?
Yeah, absolutely. So in economic recoveries, typically economically sensitive companies do better. And there are more economically sensitive companies in the value side of the market. And so typically what you see is that the earnings for these value companies increase with the economy. And then at the same time, because of that growth investors are seeing, they typically reward the companies with slightly higher multiples.
Sure. Well, and this slide is showing us kind of the same conclusion, but instead of the value versus growth comparison, it's looking at U.S. versus international. And if you look at the bottom right, you really see that gap between kind of the historical average and the current price earnings on a discount versus the U.S. So this is essentially just telling us that, again, international, just like value, international may be poised to have a recovery as we look forward over the next couple of years. Now, these transitions are very difficult to predict the exact month or quarter, and it's frankly even hard to predict the year that a rotation is going to occur. But we do know by looking at this chart that US stocks have been on a run relative to international. If you look at the far right, you'll see that area that's gray shaded. That's 13 years where the US market has been outperforming. Each of these gray areas on the chart represent periods where the US market's outperforming. If that gray goes really high, that signifies during the period significant outperformance. If it stays relatively shallow, it's just kind of a small amount of outperformance. But it has been a long time since international has really had its glory. And you would anticipate, based on a lot of the things that we've discussed today, that essentially at some point there'll be a rotation toward value, toward small, toward international. We're not trying to predict the exact month or quarter, or maybe not even the year, but signs do point in that direction. And a lot of that could be on the international side due to stronger global growth that you had spoken to earlier, Jonathan, and that we're seeing here on this chart, correct?
Yeah, so again, because the world is a little bit behind the US, we'll see kind of growth later in the year as we go into 2022. And so if we see these higher growth numbers, that could help shift the cycle to international.
Sure. Well, as we think back to our outlook, to conclude on the fixed income side, we really do think returns are going to be tied to interest rates and credit spreads, and that just makes a lot of sense. We do believe, although maybe not negative returns, there'll probably be lower returns than in prior years. But we have to remember the Fed is very accommodative, as Jonathan pointed out earlier, and they're providing unprecedented levels of liquidity. And I think that is probably going to continue to provide some downside protection. Of course, even if bonds aren't earning 5, 6, 7, 8, 9% like we've seen in some of the last couple of years, they do provide overall downside protection for the portfolio, acting as a ballast. Now, going forward, we'd say focus on credit quality, right? Don't get too tricky on these and try and go too far out on the credit spectrum. That could end up biting you. But also remember, rates could continue to increase. This slide is showing us where interest rates were. This is the yield curve for August of 2020, March of 2021, and then December of 2013. And walk us through here, Jonathan, what's happened in that 10-year Treasury yield.
Yeah, so one other thing is you'll see kind of this graded shaded area, and that's really the range that we've seen in the past 10 years. And so that 2013 period was the taper tantrum where we did see rates go up. So we're currently, at 1.6, maybe a little bit lower, as rates have come down a little bit since the end of the quarter. But we don't think that rates are likely in the next year heading to where they were in 2013. We think really we're talking more in that 2%, maybe 2.25% range. So modestly higher from here, but it shouldn't go up as quickly as it did in the first quarter from 1% to 1.75%.
And it's really when the rates increase significantly in a short period of time that we see downside pressure in pricing. But over the long haul, if they generally go up, we don't necessarily see that correlate to negative fixed income returns. Is that fair to say?
Absolutely correct. Yeah, so on this slide, we wanted to show you really fixed income returns going back to 1980. And what, a couple things to really glean is that there are very, very few years where we see negative total returns. And in fact, 3 years on a calendar basis. But you can also see that there were periods during those years where returns were actually negative on an intra-year basis. And that's really where we stand today. And so the negative returns that we're seeing right now are really because bond prices had to adjust so quickly when rates went up in the quarter. And so again, very, very rare to have negative returns. And then the other big point I'd make is that in this period when we do have a negative rate, and we're not saying that this year will necessarily be negative, but typically the next year is a good year for bond returns. And part of that is because you collect that higher yield from those higher interest rates.
Sure. Excellent. Well, we've got about 8 minutes left. Perfect timing to get through our perspectives on inflation. And I'm going to kick it off just at a high level. If we go back a very long time, all the way back to 1750, the average inflation is around 1.6%, which is pretty much where we are today. We're not too far off of that level. If we look back just over the last 50 years, you can see at the far right, we're actually a little bit below those averages. And the other thing I'd point out is this slide, each of the gray bars, that represents a recession. You can see a very short or skinny one here most recently as a result of the recession. But most times after a recession, inflation's falling, or we're in deflation, not inflation. So that's one thing just to keep in mind as we think about where we're headed over the next several quarters. Now, over the last 10 years, we are also below what the Fed funds target inflation rate is, which is 2%. And really, to get to that 2%, we'd need inflation to run at about 2.5% in order to get back to the 2% that the Fed really hopes to target long term. And this is one reason that last year they announced a change in their policy, where if inflation does get up above the 2%, they're not going to act immediately. In the past, they would immediately act to try and tame that inflation number. They're going to let it run over the 2% to try and get to an average of 2 over some period of time. So the point here, inflation is not a concern right now. It is just simply not a concern. But some people are concerned about inflation as we look forward. And this is one big reason why they might be concerned. Is this not the case, Jonathan?
Yeah, so the concern you typically hear is that with all the fiscal stimulus, the Fed supporting the bond markets, that you just have a lot of liquidity that is either going to be printed or essentially will have to see our long-term debt increase. And that is kind of one of the major concerns that people cite. Really, the second concern people are citing is the increase in commodity prices. And so again, if we look at that blue line, that has spiked and typically in the past, headline inflation has followed that. So that's kind of the other short-term concern that we're hearing. But the other side of that, though, is that when you think about what goes into the economy, commodities or manufacturing really isn't the majority of our economy. It is a consumer service-based economy. And so really wages go into that. And you had mentioned that wages are running a little bit higher than kind of that long-term average. But when we look at forward inflation expectations, while they've come up with the recovery, they're still far below where they were in that kind of 2010 to 13 period. Now, another thing to consider is kind of these inflation risks and whether they're kind of long-term in nature or whether they're more transitory. And here we're just looking at surveys showing that, yes, we're expecting prices to go up. But on the right side, we're really showing kind of inflation expectations in a different way. And this is actually being imputed from the derivatives market where they look at zero coupon bonds. So the beginning of last year, the expectations were actually increasing. And where we stand today is that they're actually decreasing.
So let's just say, and it sounds like, you know, there's two sides to this, and we'll talk at the end as we close this out, but, you know, inflation is not a foregone conclusion. But let's just say, even if inflation did pick up, which on a transitory basis is likely to happen, what does that mean, especially for the equity markets? And what we're seeing here on this slide is that unless inflation got quite high, valuations can still be justified at current levels or levels comparable to where we are now. As a matter of fact, Jonathan, we've seen in the past during higher inflation periods, again, unless it gets completely out of control, that equity returns have actually been pretty good during those periods.
Yeah, absolutely. And if we look to the right, we've kind of talked about 3%. It could be 4%. And so here, valuations and quarterly returns are relatively high until you kind of get into that 4% plus level. And no one really believes that that's where we're headed long term.
So again, we don't anticipate inflation right now. Of course, we're reassessing this constantly. So it's not that in a quarter or 2 quarters or 3 quarters, we couldn't adjust our expectations of inflation. But right now, we're not expecting a major pickup anytime soon. If there was a slight pickup, it's not necessarily negative to the equity markets. Tell me though, Jonathan, how bond markets reacted in those situations.
Yeah, so in the last slide, we showed bond returns going back to 1980 and showing relatively few down years. Here we go all the way back to 1926, and this would encompass periods that had higher inflation. And again, you'll see that negative returns for bonds are very rare. So very few of the bars are below zero.
So again, in conclusion, when we're talking about inflation, it's not a foregone conclusion that we're going to hit a bout of at least hyperinflation, the type of inflation that really could cause some problems that we saw in the late 70s or early 80s. In this slide, it's just pointing out that there's pros and cons on both sides of this argument. Time will only tell who is going to be right, but we have many factors that would lead us to believe that inflation is not a concern. I mean, think of coming out of a recession, a relatively deep one and a very unusual one with COVID and the entire service sector being shut down. You get rebounds in productivity, you get technological advancements that drive down inflation. Inflation tends to be a lagging indicator. I mean, there's just a lot of reasons. Supply chain restoration. And a lot of the supply chain, especially from countries that export a lot, they got impacted heavily with COVID. And so a lot of manufacturing came back to the US. Well, as these other countries restart their supply chains, believe me, they're going to want to be super competitive and gain back that market share. And that would not be a inflationary scenario. That would probably be just the opposite. So again, we're not saying that it's not possible. It's just not that foregone conclusion. So with that, our last slide is the SilverOak updates. As it relates to our investment quality scoring system, we had a couple of upgrades. One upgraded from watch list open, so one of our positions was upgraded from a watch list open status, and 2 positions were upgraded from watch list closed to watch list open. So it was a good quarter. We have very few positions on our watch list in total, and those that are there are beginning to be upgraded in status. We've got several white papers that will be coming out over the next couple of months and quarters. And then the great news is we are developing our return to office timeline. We don't have the details out yet, but it will likely include a transition beginning this summer with some type of full return in the early fall. And just to let people know, we are starting to have some meetings in person, of course, practicing safe social distancing and wearing masks. But as our team and as our clients get vaccinated, I anticipate everybody has an expectation that in many cases, things are going to come back to pre-pandemic levels of activity with our in-person meetings. With that, I encourage everyone to submit additional questions or topics for future webinars. If you're working with a SilverOak advisor, you can submit those to your advisor. Otherwise, you can call me at 952-896-5701. Thank you again, Jonathan, and the rest of the SilverOak team for putting all of today's materials together, and thank everyone in the audience for attending. We certainly appreciate it. Have a great day. Bye-bye.